Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 147, and in this episode we are reviewing the performance of the global markets during the 7th week of 2025, and that is from Monday the 10th to Friday the 14th of February. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where inflation picked up more than anticipated in January, providing further incentive for the Federal Reserve to continue holding the line on interest rates. According to the Bureau of Labor Statistics, the Consumer Price Index, which is a broad measure of the cost of goods and services across the U.S. economy, this index accelerated at a seasonally adjusted annual rate of 3% flat compared to the Dow Jones estimate for an annual rate of 2.9%. Excluding volatile food and energy prices, the core consumer price index increased at a rate of 3.3% over the past 12 months. Both the headline and the core inflation readings were 0.1 percentage points higher than the readings for December. Following the release of the Consumer Price Index, markets are largely expecting the Federal Reserve to put interest rates on hold for an extended period of time and have pushed the probability for the next rate cut out to September. Meanwhile, the Fed Fund Futures is also implying about a 70% probability that the Fed will cut rates only once in 2025. Across the pond in the United Kingdom, according to initial estimates from the Office for National Statistics, the UK economy grew 0.1% in the fourth quarter of 2024, beating economists' expectations for a contraction of 0.1%. The services and construction sectors contributed to the better-than-expected performance in the economy. Previously, the British economy had recorded zero growth in the third quarter of 2024, with a 0.1% contraction in October and a 0.1% expansion in November. The Office for National Statistics said that growth had picked up in December with an estimated month-on-month expansion of 0.4% thanks to growth in services and production. On Wall Street this past week, on Friday, the S&P 500 held steady, taking a breather after a strong performance earlier in the week as investors continue to focus on the latest developments on global trade tariffs. All the three major U.S. stock indices finished the week in positive territory, And this came after investors gained more clarity on President Trump's strategy on trade tariffs, which helped to boost market sentiment. The big move this week happened on Thursday when President Trump signed a memorandum outlining a plan for reciprocal tariffs. This means that the United States could impose tariffs on goods from countries that already have tariffs on American products. For the week, the Dow Jones Industrial Average added a roughly 0.6% to close at 44,546, whilst the S&P 500 rose about 1.5% to end the week at 6,114, and the tech-heavy Nasdaq Composite outperformed with a gain of 2.6% to close at 20,026. In the U.S. Treasury bond market, U.S. Treasury yields dropped on Friday as investors assessed the state of the U.S. economy following the release of a slew of economic reports during the week. Data released on Friday showed that retail sales slipped by 0.9% in January 2025, down from an upwardly revised gain of 0.7% in December 2024, and also came out worse off than the Dow Jones estimate for a decline of only 0.2%. All in all, the report throws cold water on the idea that the U.S. economy was overheating, and in response, U.S. Treasury yields declined below 4.5% as stocks rebounded off their pre-market lows. Meanwhile, investors' concerns about ad hoc tariffs were somewhat abated as President Trump opted for a structured approach as he signed an executive order laying out a plan for reciprocal tariffs on U.S. trading partners. In response to the foregoing, the yield on the 10-year Treasury bond fell more than 4.5 basis points to settle at 4.478%, whilst the yield on the policy-sensitive 2-year Treasury note dropped over 5 basis points to settle at 4.263%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite direction. That means as the yields rise, bond prices fall, and vice versa. In the crude oil market, the price of crude oil edged lower on Friday as hopes grew for a possible peace deal between Russia and Ukraine. Such a deal could boost the supply of crude oil by lifting the current sanctions against Russia. Following separate phone calls with the leaders of both countries, President Trump directed U.S. officials to begin talks that are aimed at ending the war in Ukraine. And whilst the situation remains fluid and uncertain, the prospect of peace has already started to influence the oil markets. Meanwhile, analysts at J.P. Morgan reported that global oil demand continues to rise, with demand expected to increase to just above 103 million barrels per day, and this growing demand highlights the importance of stable crude oil supplies, which could happen if the sanctions on Russia are lifted. Despite Friday's decline, both benchmarks were on track for weekly gains of about 1%, reflecting cautious optimism in the market. The price of the global benchmark, Brent crude, came to a close at $74.74 a barrel, whilst the price of the U.S. benchmark, West Texas Intermediate crude, settled at $70.74 per barrel. In the precious metals market, The price of gold fell over 1% on Friday due to investors cashing in on recent gains, a practice known as profit-taking. Nevertheless, bullion remained poised for its seventh consecutive weekly increase, driven up by fears of a global trade war in the wake of President Trump's push for reciprocal tariffs. On Thursday, Trump directed his economic team to formulate plans for reciprocal tariffs on countries that impose taxes on U.S. imports. This potential inflationary move could drive further safe haven demand for gold, which is considered a traditional hedge against rising prices. The bullish trend in gold is driven by several factors such as the trade tariffs and the prospect for higher inflation, as well as a weaker US dollar, not to mention the growing shift from paper to physical gold, which is further fueling this trend. The price of spot gold hit a new record high of $2,942 on Tuesday and was on track for a weekly gain of 0.7% before coming to a close at $2,883 per ounce. In the cryptocurrency market, the price of Bitcoin continued its consolidation as the Fear and Greed Index remained at the neutral point. The data shows that the spot Bitcoin ETF, that is exchange-traded funds, had net outflows worth over $650 million in the past 4 days. The outflows from the spot Bitcoin ETFs indicates that investors are selling their Bitcoin holdings, and that is what is creating downward price pressures. Investors anticipate President Trump's trade tariffs will spark a trade war and lead to higher inflation. Bitcoin and other risk assets tend to underperform the market when the Federal Reserve is hawkish. And given the Fed chairman's testimony to Congress this past week, where he hinted that the central bank will continue to hold interest rates steady until inflation starts trending lower. Bitcoin continues to trade within a narrow range and was last seen hovering around $97,600 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade sideways versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.21 compared to 129.19 that was recorded the previous week. Meanwhile, the standing pound was priced at 161.40 and the euro was valued at 134.84. And on the regional front, one Kenya shilling was changing hands for 28.48 Ugandan shillings and 20.09 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.78. The Kenya shilling continues to trade within a very narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves recorded another significant increase of $155 million for a grand total of $9.374 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that the central bank currently does not provide any explanation for the change in forex reserves. However, in the spirit of transparency, I have written to the central bank requesting for them to provide more information on the change in forex reserves, especially when there's a significant change of more than $50 million. I will keep you posted on the progress. On diaspora remittances, the inflow of remittances in the month of January 2025 totaled to $427 million compared to $412 million in January 2024, which was an increase of 3.6%. The cumulative inflows for the 12 months to January 2025 increased to $4.96 billion compared to $4.25 billion for a similar period in 2024, which was an increase of 16.6%. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 53% of the inflows that were received in January 2025. In the interbank market, the liquidity situation in the interbank market remained well funded following the reduction in the cash reserve ratio, and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is a rate that banks lend to each other on an overnight basis, this dipped by 20 basis points from 10.70% the previous week down to 10.50%. And in terms of volume, the average value that was traded in the interbank market, this increased to 14.4 billion shillings, up from 11.9 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the new cash reserve ratio of 3.25%, this stood at 20.2 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 13th of February, and the central bank received bids totaling to 44.25 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 184%, and the results of the auction were as follows. The 91-day rate fell by 14 basis points to break below 9% and average out at 8.96%, whilst the 182-day rate dipped by 10 basis points to level off at 9.41%. And the 364-day rate declined by 16 basis points to settle at 10.59%. In the primary bond market, the auction for the monthly Treasury bond issuance was held on Wednesday, the 12th of February. The central bank was looking to raise 70 billion shillings from the sale of 2 reopened infrastructure bonds and ended up receiving bids totaling to 193.8 billion shillings, representing a performance rate of about 277%. And the results of the auction were as follows. The first bond, which is IFB 1/2022/14, with 11.8 years left to maturity, the central bank accepted 65.2 billion shillings at a weighted average rate of 13.97% compared to the bond's coupon rate at 13.93%. The second bond, which is IFB 1/2023/17, with 15.1 years left to maturity, the central bank accepted 65.5 billion shillings at a weighted average rate of 14.28% compared to the bond's coupon rate at 14.39%. Up next is our topical issue, and this week we are looking at the projected increase in Kenya's foreign exchange reserves. The Central Bank of Kenya projects that the country's usable foreign exchange reserves are set to rise by $1.45 billion later this year, boosted by inflows from the International Monetary Fund and enhancing the country's resilience to exogenous economic shocks. For your information, the Central Bank of Kenya holds foreign exchange reserves as a safeguard to ensure the availability of foreign currency to meet the country's external obligations, including imports and external debt repayments. The International Monetary Fund is expected to disburse its last installment of financing under the current program by June 2025, and this will provide additional foreign exchange to fund the reserves. According to the central bank governor, the surplus from the balance of payments, together with the disbursement from the IMF, is projected to result in the buildup of forex reserves by $1.45 billion. In addition to that, other capital and financing inflows, including remittances, are expected to offset the current account deficit that is estimated at $5.6 billion, which is equivalent to 3.8% of the gross domestic product in 2025. The latest data from the central bank shows that Kenya's usable foreign exchange reserves stood at $9.3 billion, which is equivalent to about 4.8 months of import cover. This level of reserves meets both the statutory requirement to maintain at least 4 months of import cover, as well as the East African Community's convergence criteria of 4.5 months of import cover. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And in this regard, I would like to send a special shout out to our first 2 active subscribers, that is Stella Mungai and Evans Kindiga. and to say thank you for your continued support. And for your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major hosting directories. That is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, in every person you meet, there is a little piece of God in them. Think about it. Thank you, and God bless.